Hey everyone, this is a big warning for you guys. I know a lot of you guys do have money in the stock market. Some of you guys don't have any money in the stock market, but this is going to end up impacting a lot of people. Your businesses that you work for, they're a lot of them are publicly traded companies, and so the stock market is really the ownership of the companies that employ you and employ your family members. And so what we're looking at is we're looking at a major stock market crash in the very near future. September is known for stock market crashes. Is that a fair assessment? Some people say there's good reasons for that. Basically, hedge funds and investment banks and stuff like that, they start rebalancing their portfolios heavily in September, and that's part of what kind of sets the stage for some of these market crashes. But we got some really big things brewing. I'm going to go over just why we're in a lot of trouble with the financial system in the United States. That's kind of the market, but the market is also, like I said, the employment market. It's the economy that we all share, and the things that impact you buying a car, impact you buying a house, and impact you with your employment. So let's jump into it. Welcome to the Poplar Report. I'm Steve Poplar. I'm an accountant, and I'm going to walk you through kind of why you might not want to have your money in stock market right now. Or if you do, make sure that you are hedging that. This isn't investment advice. This is me as an accountant who's very up to date on the news and watching these markets very closely because we're moving into a troubled time. I have not said this very often. This is not like something I do like every week or every other week. I talk about a stock market crash, but really we're seeing a lot of setup right now for that type of thing. We've had a lot of things that have been brewing under the surface that are really starting to bubble to the top. And the stock market really looks forward at what's about to happen. And so these things are not quite fully boiling, but I think they're close enough that people are realizing, people in investments, the stockbrokers and all those kind of people, they're looking a little further and going, uh-oh, we're in trouble. Let's talk about why. All right, so banks are in serious trouble. We had Signature Bank, we had Silicon Valley Bank, we had these banks going down earlier this year, right? And there was this first wave of banks that came down crashing. Part of that was due to the crypto issues that they had out there, some of the embezzlement and some of the funding into these crypto coins that turned out to be bust, and there was all this fraud and stuff like that, and it started taking down banks. But we have serious trouble with the banks right now, and the banks are really, really struggling. They're caught between two rocks, and this is just kind of crushing them. And it's just a matter of time before more banks start to crumble. One, they're dealing with the bank run. Now, Americans aren't lining up and taking their cash out in dollar bills and $100 bills and stuffing it under the mattresses. But what they're doing is they're going to the bank and they're taking out their money, and then they're putting into money market accounts. And from a bank's perspective, you might as well be pulling out the dollars in paper form, because they can borrow and play with your money to no end while it's sitting in a checking account or a savings account. But once it goes into a money market account, that's kind of more like an investment. And so they're not allowed to borrow against that. So they're trying to keep their liquidity going because they got some big problems happening. But what they're finding is that everyone's taking all their cash out and moving it into these money market accounts or somewhere else, or CDs or anything else that's higher interest, but they're effectively withdrawing this cash. And we have major corporations who are moving billions and billions of dollars out of checking accounts and savings accounts into money markets. And the banks just aren't prepared for this, and we're going to talk about why. They are sitting on tons and tons of losses. So if you buy a stock, right, the idea is you buy low and you sell high, right? If you buy a stock, and the same thing works for bonds, if you buy it, you want to wait until it goes higher and then you sell it. What happens when it goes down? Well, if you're disciplined, you should have a stop loss and you should, get out. Banks haven't been doing that really. They have tons and tons of bonds that had much lower interest rates on them that they purchased. And as rates have gone up, the value of those bonds has gone down. And while bonds don't really go down as much in value, here's the thing. They're extremely leveraged on these bonds. U.S. Treasury bills, mortgage-backed securities, all this kind of stuff like that, they're leveraged up significantly. And as the interest rates have gone up, effectively it's like these stocks' value have gone down significantly. And they don't want to sell. They don't want to sell lower than what they bought in at, right? Because if they do, then they have to admit that they don't have this money, that they lost billions and billions and hundreds of billions of dollars. We're talking about trillions of dollars worth of losses that they refuse to say that they've done. They're like, oh, well, that trade isn't done yet. Once it goes higher, then we're going to sell it out, right? But the question is it going to go higher? And are they going to be forced to sell it before it goes higher? And that's where we are right now. They're waiting for the Federal Reserve to cut interest rates down back to zero, and then they'll get out from under this trap that they've gotten themselves into. But the problem is, like I said, everyone's pulling their money out. And when they pull their money out, these banks are caught because they've used that money as collateral for taking out all these loans. And so if you take too much money out of them, they have to start selling all these assets that have lost all this value. And that just starts a domino effect. These guys are really, it's one big Ponzi scheme, okay? And each bank is like that. And so it's not like It's a Wonderful Life where they've taken that money and they've invested it into your neighbor's house. No, they've taken that and started gambling on the stock market with it, basically. And they've lost money. They've lost a lot of money. And they're stuck. So when these banks start going kablooey, boom, 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 is that going to impact the stock market? Oh, absolutely it is. When they have to start deleveraging a lot of these assets, it's going to impact the stock market significantly, and it's going to impact Main Street as well as Wall Street. Also, it's not just banks. Companies are in the same spot. Now, they played a really good game. A lot of these companies went out there and borrowed a ton of money as they saw interest rates rising. They borrowed a ton of money at low interest rates. And so as interest rates have gone up, these companies are just like, they're not borrowing any money. They're just like, we got these low interest rates locked in. But the problem is, as these bonds from these companies are coming due, they're going to have to replace them with higher interest rates bonds. And so they've been making good money so far, but as the interest rates remain high, more and more of their debt is going to have to be rolled over at a higher interest rates, which means the interest rates that they're paying are going to be much, much higher as the days go forward. And American companies owe a lot of debt, a lot of debt. And as they start having to pay a lot more interest on that, it's going to really, really hurt earnings and all that too. U.S. government's basically like one big, well, I was going to say one big corporation, but really it's like one big child who has borrowed up to their eyeballs in money, and the U.S. government debt is going up and up and up, and the interest rates on that debt are going up significantly too. In the last 90 days, $1.5 trillion added to the national debt in the last 3 months. It's crazy. Southern Pepper One tracks that pretty closely and gives weekly or semi-weekly updates on that. But the simple fact is that we're creating more treasury bills, we're creating more government debt, but nobody's buying it. China is dumping U.S. treasuries. Japan is dumping U.S. treasuries. Even Europe is cutting their purchases. They're not purchasing as much. So who's buying up all this debt that the government is creating? And if you said, is it the banks? Yes, it is the banks. The banks have all this cash, and they are just, they're buying up treasury bills with it. But the problem is, if the Federal Reserve comes around and jumps that interest rate up again, it's going to make all of those treasury bills that they're buying go underwater again. And this is building up in the system. And this type of stock market crash situation is being set up. It's just going to be a bank. It's going to be a big corporation that's just going to suddenly start defaulting on stuff because they can't afford the loans that they've taken out. There's so much happening right now. Everyone's expecting the stock market to just keep going up and up and up, even though the economy keeps going down and down and down. And that's not, I mean, that's wishful thinking, but that's not how things are working. The Federal Reserve is, they have all their assets, right? They're reducing their balance sheet. They're reducing the assets that they have. They're dumping these things onto the market, which is impacting the market negatively as well. But for the most part, stock market hasn't noticed so far. But over the last couple of days, it's started to notice. And I think a lot of people are, whether it's superstition, that people are starting to look around a little nervously because it's September, or what. But what's happening is people are starting to take a little more honest look at where we are financially as a country. And we need to be taking those things seriously. So make sure that you're properly, safe, okay? If you made a whole bunch of money off the stock market recently as a comeback, cool, great, but are you protected? Because the stock market can very well go down significantly again. Stock market works both ways, right? I mean, it goes up and it goes down. So if you're in retirement age or if you're in retirement years, and you really can't afford major losses in your portfolio, well then please get it somewhere safe. I keep recommending silver, gold, metals, canned foods, becoming more self-sufficient. These are investments that you should be making. If you can pay off your house, that's a good move there too. But if you can't hold it, if you can't touch it, you don't own it. If you just have a piece of paper or an email from a bank saying that you own such and such of a thing, or that they're going to promise to give you something, such a thing by such and such a date, and then you see down buried in a clause where if they have too hard of a time acquiring this item, then they're not going to give it to you. Just be careful about what you're buying. If you're buying promises from banks that may implode, you need to be careful about that kind of stuff. Don't let your financial planners not educate you. Make sure that they're answering your questions. Make sure that you fully understand. Have them educate you on what you're buying and what your money is in. It's not that complicated for you to understand it. Okay, it's your money. You need to watch out for you, because no one else is going to do it for you. No one else is going to do it for you. You need to ask the hard questions and understand what's going on. And make sure that you're protecting yourself. If you have a financial planner, tell your financial planner, hey, this is what I'm trying to accomplish. How do I do this? And get some good advice. And hold their feet to the fire. Ask them what will happen if the stock market drops 15%. What happens if the stock market drops 30%? What happens if the stock market drops 40 or 50%? What's going to happen in bonds then? Ask them that. Ask them what happens during a market crash to bonds. And if they know anything at all, they'll tell you that the crash in bonds usually is worse than the crash in stocks. That's history, folks. And the financial planners that don't know that, and they tell you, oh, well, we'll put a bunch of safe money in bonds. That will counteract the risk in stocks. That's like, I don't even know where that comes from. Bonds are not safer than stocks. They're just different, okay? They're different. And in some ways, they're much worse than bonds, much worse than stocks. Bonds actually will drop harder during a market crash than stocks. And most financial planners don't know that. Most of the financial planners around haven't experienced 2008, and they certainly haven't experienced 2001. If you have an older investment advisor, awesome, that actually can remember those events and live their lives by it. But if you have a bunch of guys that are super young and they haven't experienced those things, haven't been in business since 2008, you got to watch yourselves. Ask those hard questions. All right, folks, thanks so much for watching. If you want to check out another video from this channel, there's one right up here. I'll see you over there, or I'll see you guys later. Steve Poplar of the Poplar Report, out.